Hey everyone, this is Kirk here again at OptionAlpha.com, and in this video tutorial what I'm going to cover are contingent orders. So these are really the top 5 contingent orders that traders like to use in the market. And actually, before I begin this video, what I want you to do is just quickly add your comment to this post or this video and let me know which one of these you actually use the most. I'd be really interested to see if you use stop losses versus trailing stops or regular contingent orders the most as a trader. So what we're going to do is we're going to go through the 5 different contingent orders here, and at the end of this video you'll have a complete understanding of how they work and how you can use them with your trading. So the first one we're going to take a look at here today is just the regular contingent order, and this is one where you have an index or a stock or whatever you want to trade, and you place a contingent order to either buy or sell the security. So in this case with the UVW index, let's say that you buy the stock at $100 or the index at $100. What you're going to do is you're going to place a contingent order at 0.2 to actually sell whenever you get a 1.2% profit. So what that's going to do is it's automatically going to trigger a sell signal, and you're going to sell out of your index. On the bottom side of this chart, you can see that you have XYZ stock. So let's say that you actually bought the stock at $25, or you want to buy the stock at $25. So you're going to place a contingent order to buy the stock whenever it gets down to $25. In this case, you wait a little bit and then it gets down to $25, and in circle 4, you're actually going to have an order automatically go into the market that's going to buy that stock at $25. Now, should XYZ stock never trade to $25, your order never gets entered into the market. Now let's talk about multiple contingencies. In this case, this is where you enter an order that has 2 sets of criteria or multiple contingencies. So one order is going to trigger, or the other order is going to trigger, if that set of criteria gets filled first. In this case, we have XYZ stock again that we bought at $25. We're going to automatically place 2 contingent orders around that initial purchase. One is going to be to sell the stock at a loss at $20, and so that's in circle 2A. The other is going to be to sell the stock at a profit when it reaches $32. So now you can notice that we've kind of bracketed the market. We've taken our profit target, and we've also made note of our minimum loss, or where we want to make that loss stop, or the stop loss. And these orders are going to be working at the exact same time. So whichever one fills first, that's going to be the order that gets there. So if XYZ stock, in this case, trades all the way up to $32, the sell order to sell it at $32 goes, but your order for $20 still keeps going. So you have to remember to cancel that one back. But this is a really great way as a trader at home or someone who works on a job, a regular day job, to make a trade and have predetermined risk and predetermined profit targets. Awesome, awesome way to do that. Now let's get into one that's a little bit more complicated. This is one triggers other, or OTO, as they're usually called in your order screen. So in this case, one contingent order that gets executed is going to trigger another contingent order to be placed in the market. So consider it the kind of domino effect that you might have in trading. In this case, let's say that we want to buy XYZ stock at $30, okay? Right now in circle 1 on the very left-hand side of this chart, you can see that XYZ stock isn't trading at our $30 target yet. So we're going to wait to buy XYZ stock until it hits $30. That happened at circle number 2. Now at the exact same time that we buy that stock, we already have another order that says, okay, at whatever price it gets bought, we're going to have in this case, $2 trailing stop loss. So what that's going to do is automatically enter an order that's contingent upon the fact that if XYZ stock trades down to $28, then we're going to sell out at a loss. But if XYZ stock starts trading higher, our order is going to trail the stock dollar for dollar, $2 all the way up, okay? And it will automatically stop at any point in which the stock starts to reverse, okay? So it's just trailing on the way up. It's not going to trail it on the way down, and that's a real key point to remember. So let's say that from point number 2 all the way up. The stock trades all the way up to back up to $35. Okay, and you can see that from point number 3, our trailing stop that was originally at 28 has now trailed the stock all the way up to point number 5. After it reaches $35, you can see that XYZ stock starts to sell off. And you can see that our level at 5 never changes. So we actually end up selling this at a gain of about $3 here, and we sell it at $33. So you can see how one order, the execution of one contingent order, actually created the other order out of really thin air. And that's really what you want to set up, these multiple scenario orders that are contingent upon each other. Now let's take a look at a different example. This is one cancels other, or an OCO. In this case, this is similar to our multiple contingencies screen that we looked at 2 slides back here. So in this case, let's say we bought the stock at $23 in circle 1. Now it's traded up to around $25. So in circle 2, it's at $25, and we want to again target both our profit and take out and measure our risk, or put in a stop loss order. So we're going to put in 2 different orders, but whichever one gets executed first, the other order gets canceled. So you always know that it's either going to be one that gets hit or the other, and the other order is going to automatically be canceled immediately. So in this case, we have an order to sell the stock at $27, and that's circle number 3. So if the stock trades all the way up to $27, we're going to sell it immediately. In circle number 4, that's our stop loss. So we're never going to lose more than $1 from where we are right now. And again, if it traded all the way down to 24, that would get executed first. So in this case, XYZ stock continued to trade up and trade all the way up to point number 5, in which case it hit our $27 target. So that's where we actually sold the stock, profited, and took the money and put it in our pocket. And you can see that our order down below was automatically canceled. Because the other order was executed, the other order below had been canceled and removed from the market. Now let's look at a trailing stop. This is what we had looked at again 2 slides ago, where we buy the stock at say 25 in XYZ, and we want to trail the market by a certain percentage or a certain spread. In this case, we're going to trail it by about $1. So from point number 2, where the stock is trading at $27, our stop loss order, or trailing stop, is going to go in at point number 3, which is about $1 below 27. It's going to continue to trail the market dollar for dollar as the market improves. If the market decreases, or if XYZ stock starts to sell off, then the trailing stop stops at that level and levels off. Okay, it's not going to go down from there. It can only lock in profits. It can't increase your loss. So as the market continues to go higher, you can see that around zone number 5, we had a little bit of downward movement in XYZ stock, but our trailing stop loss order did not move. As the stock continued up to 29, again, we trailed it by about $1 all the way up until we eventually sold it at $28 over in circle number 6. So again, you can see how this trailing stop will help lock in profits for you while you're not trading. You can be totally away from the market and set these trailing stops, and it just moves with the market lockstep all the way up, locking in profits. Okay, so those are really the main contingency orders that you need to be aware of as a trader. And this is really going to help you both in your options trading and your stock trading, obviously. This is a really great thing to really dive into this week and understand, because the more you can understand about these orders, the easier you can make your life, the less risk you're going to take in the market, right? And you're going to be able to start trading more while you're not watching the market, right? We all don't want to sit in front of the screen all day and watch all these orders. So if you can learn to set up some of these trailing stops and contingent orders, or one cancels other, then you can start to really strategize with your orders and set profit targets and stop loss targets and be a little bit more of a complete trader. So as always, I hope you guys really enjoy these videos. Please add your comments. Let me know which one of these contingent orders you use the most. I'd love to hear what you guys have to say. Happy trading.